Stephany, over to you.
Thank you very much, and thank you for the invitation. It's a very exciting conference. I'm delighted to be here. So I want to make first some general comments about private investment, including the point that Kevin asked me to address, and then I want to talk about a new phenomenon, which is the fact that low-income countries in Africa are now raising a lot of money on international bond markets, particularly for sovereign bonds, and some of the benefits and risks of that. And on that I want to use a lot of the good work that is in a paper that Dirk de Velde has produced. So the first general point I want to make about finance is that one tends to discuss quite a lot about how private finance needs to be mobilized. But I think we also have to remember that this takes place in a kind of broad regulatory framework, both nationally and internationally. And this framework is being radically reworked, perhaps not sufficiently, as people like myself think, but is being radically changed in basically G20 bodies, the Basel Committee, the Financial Stability Board, and others. And Simon already referred to it this morning. So there is an issue of why are no LIC countries, no low-income countries represented. And I think it's a really important issue that these LIC countries are not represented at all, when, of course, they also need a functional financial sector. And it's good that at least the large developing countries are now represented, like India and Brazil, but no low-income countries are represented. And this is important for two reasons. One is that developing countries in general, developing and emerging economies, are very interested that there are no crises. And the last big crises have actually been in developed countries. So do no harm principle. So we need regulatory principles for that. And secondly, the regulation of finance has to be adjusted. For example, bank regulation doesn't have to be the same in Zambia as it is in the UK. The financial sector is very different. Or in Kenya, you have to regulate M-Pesa maybe, but you don't have to regulate derivatives. So the kind of challenges are very different, and therefore it's very important that developing countries are represented. My second, I think there is also a very interesting area that has moved on, where the International Monetary Fund is now very open to developing countries and emerging economies regulating capital flows, which is, I think, an important step forward. Maybe it should have been there a bit before, but one shouldn't complain about good things happening. My second point, general point, is relates very much to the issues that you were raising about financing important development targets, particularly in the area of sustainability, climate mitigation, for example, renewable energy, and also making the development model more inclusive. For example, as you were saying, lending to poor people, lending to SMEs. I think there is an area which is very clear when projects are profitable on their own. And there, the private sector can do it. If they are willing to support, particularly if they're willing to support maturities that are sufficient. And that's why I've always been very interested in what insurance companies, pension funds can do, because they are the kind of capital that development finance experts love, because you're patient capital. So we love that. How can we get people like yourselves to invest in a major way in poorer countries? And I think this is all very positive. But there are also limits, and I think you've been already... I've been doing some interviews, and then you say, to invest, say, in renewable energy in Africa, and I've talked to some institutional investors, they say, oh, well, Africa's very risky, and they generalize about across the region. They forget about the differences, and they say, oh, we need 25% per annum return. But of course, we want to help the poor and so on. And this is where you have to be a little bit careful about all this kind of win-win-win. Okay, we're going to be sustainability, we're going to help the poor, and we're going to make big profits for the private sector. Well, I'm sorry, it doesn't always add up, because if you want to give these people 25% profit, you either have to raise the price of energy to very poor people, or you have to get the government to give major subsidies, which is difficult for a low-income government, or you have to get donor money, which is nice if you can, or the government has to basically do it itself. So maybe it's better if there are these very high requirements of profit, then in that case it's better for the government, the national government, possibly with donor support, to do it itself. So you have to always be comparing, I think, what works best for development, what works best for poor people, rather than thinking that always automatically the private sector solution will be better. It may be better in some cases, but it may not. And where these things work, where the blending of public and private resources, like you're explaining for this DFID case, like we studied for, say, Norfund, Norfund is a sort of public, a sort of development bank in Norway, which funds green energy projects in Africa. They get a return of 13%, okay, not 25, but 13%. I think they should showcase much more what they do, because then you can bring the private sector in. So I think it's very important to be very pragmatic about these things and to look at what is most cost effective in a developmental sense. So secondly, thirdly, I think, I want to talk a bit about capital flows, and particularly the surge of bonds to fund sovereigns in Africa. And as an introduction to that, I didn't know that Yo would be here, but I wanted to quote him, is that I think African countries in particular have to start by mobilizing their own local resources, as you discussed yesterday. But I think especially there is a particular opportunity, because a lot of countries have found quite a lot of mineral resources and oil, and so you will have a lot of your own money. And therefore, and this is Yo's nice phrase, a lot of economists will start telling you, oh, this is terrible, you will have the resource curse. And then following Yo, I will tell you, no, how can you make this resources a blessing? How can you mobilize your own resources through an effective financial sector, through development banks, and to use it in a way that can help you fund long-term development? And I think this is a first step. And if you look at countries like Norway, of course, much more developed, they have a very good sovereign wealth fund. If you look at a country like Chile, they have a very good stabilization fund, which is used both for long-term investment, but also to protect against shocks, and is linked to a counter-cyclical fiscal rule, which is now being studied by the EU, because the EU has very bad fiscal rules. Now, finally, on the bonds. So the first point is we have to remind ourselves that capital flows come and go, that there are surges and reversals. We know this from emerging economies, we know it from the European periphery, and there is also a history in sub-Saharan Africa. This thing about, you're fantastic, you are the frontier markets, we've heard this story before. It's very nice to hear, because it shows your success, which has been important. But you must also be wary that private flows, particularly short-term private flows, are fair weather friends. So they will be there particularly when you don't need them very much, and they may withdraw when things get tough. So I think caution is a very important thing. So how much have these bond flows increased? According to latest IMF reports, by now, by September 2014, there is $14 billion of inflows. Actually, it's a lot of money that's coming to particularly low-income countries in sub-Saharan Africa. Last year, it was almost $5 billion, whereas, say, in 2007, there was only $1 billion. So there's a major jump. And again, as I said, proceed with caution. I think there are, in general, of course, there are important advantages. First, as I say, it reflects success. It makes countries less dependent on aid. and on apparently less conditionality, because ex ante there's no conditionality. They just want to invest, but there may be ex post conditionality when things go wrong, and you have, of course, additional resources. But you have to hear the voices of people like Christine Lagarde, not exactly a radical academic, who says this is additional finance, but this is additional vulnerability. And more strongly, my boss, Joe Stiglitz, who says there are enormous downside risks and limited upside potential. So I think one way of looking at foreign flows is that you have to say, what are the preconditions that this will help development? And I think the first one is, and I'm drawing here on Max Corden's principles. One is that a lot of these flows should really go into investment, so not government consumption, but investment. That this investment should generate production of goods and services that directly or indirectly increase tradables, because in the end you just have to service and pay back the loan. That the investment must be effective, and we there have our Ghanese colleague making sure it is effective. And fourthly, that the capital flows are stable in time, both in terms of availability and cost, because these bonds, for example, on average for Sub-Saharan Africa are about 8 years, but some are less, and you have to come to a point when you have to renew them. And then, of course, if the money is not there or it's much more expensive, then you will have problems. So these conditions are quite stringent. If they can be met, it can be used very well and it can be helpful. But the more you borrow, I think the risks become higher, particularly because the international environment is always uncertain. So you can either have problems in your own country or you can have problems internationally, and therefore you have to be very, very careful. And one final point that again Dirk has highlighted is, of course, you have to also look very carefully at the contracts that you signed. The developing countries have often been stung. In the 70s, they borrowed at apparently very low rates, but the rates were variable. And when Volcker raised the interest rates from about 4% to 20%, we had a major debt crisis. Secondly, Argentina is now suffering from these so-called vulture funds. And this is because the contracts didn't have these appropriate collective action clauses, which most bonds now have. But there is a technical issue there about looking at the contracts very carefully, not just for problems that have arisen in the past, but also potential problems that can arise in the future, so that the country is protected. So I think these are the ideas, just to finish with a little bit of a simple line, but maybe important. The idea is to kind of put finance at the service of development and not development at the service of finance.
Stephany, thank you so much for that. And I think in particular for drawing attention to these potential trade-offs, which often get swept under the carpet. And the contrast is often made between these huge infrastructure investment opportunities in Africa on the one side, with very high social and economic returns, and these vast 20 trillion of savings in pension funds and elsewhere. And there's a sort of assumption that aligning the two is relatively straightforward, but the terms for that alignment and who bears the risks and the balance between profit and public interest and so on is clearly very important. So there's plenty to get our teeth into there. We've got 40 minutes for discussion, so I'm going to throw it open and maybe take questions in clusters of 3 or 4, depending on how long or short they are. And if you could say who you are as well, please. Thank you.